Economic recession should not stop you from investing. As an investor, you invest during recession and as well as when the economy is in good shape. So in this video, I want to highlight how you would invest in stocks during economic recession. So what strategies are you going to really adopt to be able to succeed as an investor in a recessionary environment? Investing in stocks, during economic recessions requires a strategic approach. As market conditions are typically, more challenging and uncertain. So here are some strategies you could adopt as an investor during economic recession. Number one is focus on defensive stocks. You focus on defensive stocks because of the stability they provide. Invest in companies that operate in sectors less sensitive to economic recessions, such as utilities, healthcare, and consumer staples. These sectors are not the least affected by economic recessions. Recession or not, people will still rely on gas supply. They will still need water, electricity, and the rest. They still need treatment in terms of health, illness. In terms of illness, ill health, you still need to have access to medical facilities. So these sectors are not really least affected by recession. And you invest where there's consistent consumer demand. The sectors tend to have steady demands for their product and services, making them more resilient in times of economic downturns. Number three is consider high quality blue chip stocks. You consider high quality blue chip stocks, popular companies with very strong balance sheets, with history of outperformance. Companies with very strong fundamentals. You invest in them. And equally invest in dividend paying stocks, dividend aristocrats. Blue chip companies are known to pay dividends, so that at least whatever comes in as dividend will be able to support you in times of economic downturn. Number three is diversify your portfolio. You inculcate risk management. You diversify your investment across different sectors, different asset classes, different geographical regions, to reduce the risk of a particular area getting subjected to economic downturn. So if you invest abroad and those countries are doing very well, you discover that recession in your home country will not really affect your portfolio that much. You equally have strategic asset allocation. You allocate your money, your funds, your capital into assets like bonds, like cash and other assets, and even alternatives may come into play to be able to adequately diversify your portfolio and manage risk. Number four is look for companies with strong balance sheets, companies with fortress balance sheets. You consider low debts, companies that have low level of debts and they have strong cash reserve. These companies are better positioned to weather economic downturns successfully. You equally, crave financial stability. Companies with robust financial health are more likely to survive, economic crisis. So you invest in those companies. Number five is invest in dividend stocks. Stocks that generate income. Dividend paying stocks can provide steady income during recessions, which can cushion economic effects on you as an investor and even as an individual looking to pay bills. You equally have that concept of reinvestments. Consider reinvesting dividends to take advantage of low price stocks. so as to be able to boost your portfolio strength. So whenever there's recovery, you discover that you come out fine because of appreciation of your stocks, because you bought them when they were at a very low level in price. Number six is evaluate valuation levels. You take advantage of buying opportunities. Look for stocks that are undervalued based on their intrinsic values. So you buy those stocks because they give you opportunity for growth in the future. They have that growth potential in them. Recession can equally create buying opportunity for long-term investors. In a recession, and you have enough cash available, it's a buying opportunity. You buy companies with very strong balance sheets, strong companies with at a lower cost, at a lower price. Because when the economy bounces back, these companies will then be at the forefront of those that will perform very well. You also consider margin of safety. Focus on companies trading at below intrinsic values. We provide this, this will provide a kind of margin of safety. So in case you made a mistake, you still will not record losses because you bought at a sufficiently low price. That is at a price considered below intrinsic value. Number 7 is consider defensive stocks. You consider defensive ETFs and mutual funds. So it has to do with sector funds that invest in ETFs or mutual funds that focus on defensive sectors or have a history of outperforming during market recessions. So mutual funds and ETFs that focus on defensive stocks will perform very well during economic recessions. You have stocks that are defensive in nature. So buy ETFs or mutual funds that invest in them. Not only that, you consider diversification. These funds provide diversification and professional management, which can help mitigate risk during downturn. They are managed by experienced, skilled professionals that know how to navigate, investing during economic downturn, during economic recession. Number 8 is adopt a long-term perspective. Nothing lasts forever. Be a patient investor. Invest patiently because recessions are known to be temporary. They don't last forever, and market tends to recover over time. So maintain a long-term approach. Adopt a long-term strategy. So buy when prices are low. Buy as much as you can buy because eventually they will then recover. And so stick to your plan. Don't allow recession or economic downturn to derail your plan. As a long-term investor, you view economic recession as a kind of noise. And so you focus on the long term and wait for the market to recover, which eventually the market will recover. Number 9 is monitor economic indicators. You monitor economic indicators. Stay informed. Keep track of economic indicators such as unemployment rate, GDP growth, as well as some consumer confidence to gauge the state of the economy and then to be able to base your investment decision on those conditions. Not only that, you adapt you adapt strategies that will help you to be able to ride out the recession successfully. So in this case, it might involve being prepared to adjust your investment strategy based on changing economic conditions and market signals. So you should be adaptable. You should be able to adapt. Number 10 is explore alternative investments. You kind of hedge against volatility. Consider alternative investments such as gold, commodities, or real estate, which may offer protection against stock market volatility. When the market is gyrating, real estate prices and gold and other commodities maybe offer some level of stability. And then, you should equally incorporate risk diversification. So in this case, alternative can provide diversification benefits and reduce, overall portfolio risk. Number 11 is be cautious with leverage when it comes to a recession. Be very cautious how you borrow money. Avoid high leverage. During recession, high leverage can increase risk. So focus on investments that do not require excessive borrowing or risk, or risk taking. Go for safer investments that are kind of, don't really, uh, not all that risky, like bonds, corporate, municipal bonds. Avoid junk bonds because they are likely to default. It's very risky during recession. And so you learn to manage risk. Ensure your investment approach aligns with your risk tolerance and financial situation. And so investing in stocks during economic recessions involve focusing on defensive stocks, high quality blue chips companies, as well as using a diversified portfolio. Consider dividend stocks, evaluate companies very well so as to be able to determine their economic conditions, their financial stability, and invest in defensive ETFs as well as mutual funds. Maintain a long-term perspective and monitor economic indicators adequately. You also explore alternative investments, for added protection. Avoid high leverage. Avoid, risky investment like junk bonds. And this will help you to be able to navigate, the challenges of recession and to be able to come out unscathed.